Good morning, everyone, and welcome back for day 2 of Cherry Bekert's 2021 Industrial Manufacturing Virtual Conference. My name is Matt Brady. I'm a tax partner and leader of Cherry Bekert's Industrial Manufacturing Industry Group. For those of you who joined us on day 1, you'll recall that we had an insightful presentation from Chad Mutray, Chief Economist of the National Association of Manufacturers, who provided an economic manufacturing outlook for 2022. Then our panel took a deep dive into the push for Industry 4.0, in particular, the ongoing digitization focus. Both of those sessions highlighted the challenges and increased need for agility in the industrial sector right now. Today, we're going to switch gears a bit and focus on the challenges facing manufacturers from a tax perspective. Our first presentation will help highlight the proposed tax legislative changes on the horizon and review tips to help your business maximize tax savings while ensuring compliance. Then we're going to shift our focus to a variety of tax considerations important when making supply chain changes, such as international tax considerations when considering onshoring, nearshoring, or structure changes, utilization of tax incentives to maximize after-tax dollars, state tax considerations when making supply chain shifts, and creative funding concepts to subsidize expansion costs. So before we get too far into this morning's conference, I do have a few quick housekeeping notes. To receive CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. A short survey will post at the conclusion of the webinar. We do appreciate your feedback. It helps steer future content and future information share. CPE certificates will be issued via email within 10 days. If after 10 days you have not received, please email cbhlearning@cbh.com. A recorded version of this webinar will be available in about 1 week. It will be sent via email and posted to our website. For those of you who attended day 1 of our virtual conference last week, you will be receiving a recorded version of that webinar as well. For those of you who missed last week, the recorded version is available on our website for viewing at your convenience, or you can message us for a copy of that presentation. If you have any questions during the webinar, please type them into the Q&A window located in your control panel. We'll be monitoring it in an effort to address during the presentations. All right, now that housekeeping is behind us, I'd like to welcome our 3 presenters who will be leading us through our first session this morning. Today we have with us Ron Wainwright, Brian Dill, and Kathy Stanton. So why don't we let each of you go around and give a quick intro, then we'll get started. So Ron, how about we start with you?
Well, good morning and welcome. We're glad you joined us today. So my name is Ron Wainwright, and I'm a credit and accounting methods partner with Cherry Bekerт.
Good morning, I'm Brian Dill. Good to talk to everyone this morning. I am the international tax leader and a partner with Cherry Bekerт, and I've been doing the international tax gig for a little over 27 years now.
Good morning, my name is Kathy Stanton, and I lead the state and local tax practice for the firm. Been with the firm since about 2009, 36-year practice, which makes me feel very old, but glad to be with you this morning discussing some SALT matters.
I know I gave a quick agenda back in the opening, but again, goal here is to share current status of the Build Back Better plan. Summarize some of those proposed changes, in particular, how we should be thinking about them from a federal, international, or SALT perspective. And then throughout, we're going to talk about some near-term planning opportunities, not only as we close out 2020, but as we ring in 21. So with that, Ron, I'll hand it over to you and kick us off.
Thanks, Matt. So let's start out with a polling question. We all read the press, we all watch the news. Obviously, there's a lot of things going on. But what percentage do you place based on current events, news articles, toward the passage, what is referred to as the Build Back Better plan? All right, I think we're done with the poll, and you have answered across the board. So there's a 13% at no chance, 26%, less than 25%. The majority, actually 32%, believe there's a flip of the coin, a 50-50 chance that it'll pass prior to year end. And then obviously 19% at 75 and 11 at 100%. So let me start with a quote. as we talk about a lot of the kind of the unbundling of what we would refer to as the infrastructure bill coupled with the Build Back Better plans. So when you think about, I'll say the quote, it says, first, get your facts first, and then you can distort them as you please. So that's from Mark Twain, who suggests getting the facts first. And that's what we're going to do today when we think about where are we, where could we head prior to year end, recognizing it's December 15th. Now, I will tell you, I will move through the first 11 slides quite quickly, but it's just to lay a foundation, or in essence, to get our facts first. And then you all can decide through the presentation of what the expectations are as we talk. So we know the Democrats control the House. However, they control it by 3 votes. And that's very important from the standpoint of what we saw with respect to the infrastructure bill that was passed on November 15th. And more importantly, what we saw in regards to the passage of the House, the Build Back Better plan that is now sitting in the Senate. So the bottom line is there's a slim majority in the House. And then, as we know, the Senate is literally split 50-50 from the standpoint of just right down the middle from a Republican and Democrat perspective. And that becomes important as we kind of look through kind of debundling the Build Back Better plan and what is the real possibility of passing and what has happened really since the October timetable. So we all know that there's some key policy movers on the House side that caused Speaker Pelosi some significant challenges in the ability to pass the Build Back Better Act on November 18th. And then we have some moderates in the House, which are led from the Problem Solvers Caucus perspective. When you think about the Senate, I think everyone should now be familiar with Senator Manchin, a Democrat from West Virginia, and Senator Kristen Sinema from Democrat from Arizona, because they have really largely dictated the contents of the Build Back Better Act, and candidly, the speed in which it has or has not advanced. This candidly has challenged the leader, Senate Majority Leader Schumer significantly, as he made comments several weeks ago on the Senate floor of attempting to take the Build Back Better plan candidly to the Senate floor sometime next week. So let's kind of talk just at a high level of what's happened and what is occurring. So we know that the Infrastructure Investments Jobs Act was signed into the law by the president on November 15th. This is also known as the Bipartisan Infrastructure Framework. And there were very few tax provisions, but probably the notable exception was the early stoppage of the employee retention credit from that standpoint. And of course, as I've highlighted here, the bill provided $1.2 trillion, but they used $500 billion coming out of the CARE Act. And obviously, when you start kind of pulling the numbers together, you can see the significance of the Build Back Better Act insofar as the dollars as well. So one thing to pay close attention to, and for those of you who read early news and or looked at the House and the Senate side last night, you know that there was a debt limit and a government funding issue that ultimately was on a procedural vote agreed to by the minority leader McConnell, coupled with Schumer, that basically the Democrats could go alone in regards to increasing the debt limit. Now, December 15th, today was an important date because Secretary Treasury Yellen indicated that this is the date that the government will run out of money, knowing we're a fiscal year end at 9/30. So what transpired last night was ultimately the Senate passed a $2.5 trillion increase to the debt ceiling, which takes the debt ceiling to $31.4 trillion. And it should go past the midterm elections into 2023 from that standpoint. That becomes very important as we look at Build Back Better. So we know it was President Biden's agenda. We know the Republicans want the Democrats to go alone. And we know it started at 3.5 to 3.75 trillion. And some of you may know the term now that's being used by Senator or for Senator Manchin, as well as Sinema, being called Mancina from the standpoint of Build Back Better. So let's talk about what is in Build Back Better. What are the new provisions? What are the provisions retained? And then obviously I'll hand it over to my colleague, Brian, who will talk some of the international tax provisions. So the new provisions, though Senator Manchin, but predominantly more Senator Sinema, stopped really the increase that was originally proposed in the American Jobs Plan, the American Rescue Plan. So we have no tax increases in regards to corporate, stays at 21%, or at the individual rates that sit at 37%. However, there is this AMT that was reintroduced, which is basically 15% of adjusted financial statement income on applicable corporations, which are really the billion-dollar type book income type companies. Now, over the weekend, to show how this moves so quickly, because the bill is on the Senate side, Senator Wyden, who chairs the Senate Finance Committee, put out legislation. It would actually modify the AMT calculation to really broaden the base a little bit. So this is scheduled to begin effective January or post 12/31/22. Another big revenue raise in Build Back Better is the stock buyback tax, which is a repurchase after 12/31. Basically is simply 1% of the fair market value, and the tax is not deductible. But this is where we get into some of the surprises when we think about Build Back Better. I mentioned that the individual rates do not increase, they stay at 37%. But you have a number of surtax provisions in there that are going to impact individuals, and more importantly, industrial that may be an S corporation. Not a C Corp, but an S corporation or any type of pass-through entity. So there is a surtax of 5% upon MAGI, which is in excess of 10 million for an individual. There's also an additional 3% surcharge on MAGI in excess of 25 million. And MAGI, as I've defined here, is simply the adjusted gross income less investment. There's a 5% surcharge in estates, and there's an additional 3% surcharge on excess of 500,000. So there are some surprises. One of the things we need to pay attention to is the child tax care credit, which the last payments went out actually today. And this is a strong focus of the Democratic Party. I'm an independent, but the child tax credit is called to be extended. It extends it at a higher credit amount for 2022, as I've highlighted here. And then there are some phase outs. But that is a pressure point, candidly, for the Democrats on the Senate side to get Build Back Better passed, because it has to pass back to the House before it can ever go. So let's talk about some of the provisions that will retain from the House Ways and Means markup, because these are, again, some surprises. So you have the 3.8% net investment tax, or what's often referred to as the NIT, which is applied to the greater of the net investment income or the specified net investment income based on these high income individuals, again, effective post 12/31/21. So when you begin to think about the pass-through entity income tax and the definitions that are there, one of the surprises is in regards to specifically when we think about how they're going to tax the NIT. And let me go backwards in my slides here. So when we think about the NIT, it is going to be applicable to ordinary income that passes through from S corporations and partnerships. So usually it was on a passive basis, but now it's on ordinary income and passive. So that is an extremely large revenue raise coupled with the international side. And again, this is the slide that I was kind of highlighting there, where you're going to compute that extra net investment income tax. There's also some surprises in the sale of investment assets, changes in regards to qualified small business stock, where they're reducing the gain exclusion from 100% to 50%. And these sales or exchanges are after September 13th. So pay attention to that from that standpoint. And there's a number of provisions in here that are around sale losses and constructive sales. There's also some significant changes in common control, and they're broadening the base. That's what I'll say about this slide, is that common control is defined in the statute, but it expands the entities under common control. Why are they doing that? To raise revenue. There's other provisions, specifically in R&D, where they would have been required to begin to be capitalized. That seems to be kicked down the road, or the date is moved back after the Tax Cuts Jobs Act of 2017, from officially January 1 of 22. Now it'll be for January 1 of 26. However, I would point out that over the weekend, there was some language changes in regards to that capitalization. And there were also changes in regards to some of the other provisions, specifically in BEAT, as well as the dividend received deduction. Now, most believe that what Senator Wyden put out over the weekend in his text were simply negotiating points in regards to what ultimately could or could not happen. So here's the question, polling question number 2. How many of you all have begun your year-end planning, recognizing that we're in a state of flux in regards to the Build Back Better plan? All right, so 24% have indicated, or 26% have indicated they have not started due to the uncertainty of Build Back Better, 30% no, and 44% yes, which ultimately begs the question of, well, what should I be doing now from a year-end planning perspective? So in the time I have left, I wanted to highlight 15 year-end tax planning questions that you need to be asking from a corporate or pass-through entity perspective. First of all, have you applied for the employee retention credit? Remember, that was retroactive, going back into the 20 year, and then also through September 30th of 21. If you deferred payroll taxes in 2020, remember that you've got in 2 installments, have to begin to repay that. So these are questions that you need to be asking yourself that are contained in the slides that we will post out. Do you have an affiliation with any non-US companies? What's happening with your supply chain, which we'll talk in the next hour on. There's transfer pricing documentation on the ITAX side that's very important. Of course, the question is, do you project higher profits and taxes in 2022 versus 2021? What changes has the company implemented as a result of COVID-19 and the pandemic, where there might be federal subsidies that could be captured? Nexus, which Kathy will talk to, is very important. Have you received ultimately your confirmation of the PPP loan forgiveness? In fact, if you applied for it, because the banks or the SBA has been very, very slow. And then, of course, probably the last 2 questions are very important. What's your growth strategy or exit strategy for the business? And what or which areas of proposed tax law changes hopefully we can assist you with in regards to some more modeling. So I put a couple slides in there in regards to steps to take in 2021 if taxes increase, which means that we think Build Back Better is going to happen. And then, of course, those surprises or surtaxes are going to impact you. And then also, when you think about steps to take in 2021 if taxes increase, here's some other items around your 263 Cap A cost, repair cost. I mentioned the capitalization of R&D expenses, capitalizing your carrying cost, electing out of installment sales so that you're bringing income forward into 2021 as opposed to 2022. But there are more steps in 2021 as well, and I've tried to highlight those from an inventory perspective, and also considering change in tax entity, recognizing the rate arbitrage. Obviously, from an inventory perspective, with inflation rising, changes from LIFO to FIFO, And you can also change from cash to accrual if you can qualify. If you believe income will decrease or stay the same in 22, there's reverse suggestions on the prior slide. So what you wanted to do is obviously, if it stays the same, you want to kind of just keep the planning the same. And then I'm going to hand to my colleague now, Brian, who's going to cover some of the international tax provisions that are within Build Back Better.
Thanks, Ron. Let's go to the next slide. So these are the key international tax proposals. And as I think you can see really quickly, they're in the weeds. So I think the big thing to take away from an international tax proposal this time is that these are not readily apparent. They're buried in the legislation, and it's not simply a rate increase on the international side. But the surprising thing is when you go to the scoring for revenue raise, unfortunately, international got the short end of the stick here, and that largely US companies doing business overseas are going to be paying for Build Back Better. And the revenue raise is largely coming from international. So I think that's the number one takeaway point, is that if you are operating overseas in almost any capacity, I think you should think that you will be facing a tax increase from your international operations, because that's exactly what the Build Back Better plan is meant to do, is focus on US companies operating overseas to pay more money. I think you've heard it in the news consistently that US companies operating on a global basis are not paying their fair share. And that's what we're seeing here in these very specific items, which is the GILTI, foreign derived intangible income are the big ones. And we'll talk a little bit in a minute about the foreign tax credit. I would say the other takeaway here is increased reporting, and we'll go through this in a second. And then I think the number one is, if you're operating overseas, you should expect a tax increase. I think number two, and we'll go through this, the silent or the quiet thing that's happening here is the way they're implementing this is going to greatly impact your tax reporting cost and your administrative requirements, if whether you have the necessary accounting systems to gather all the necessary information, because what Congress is doing here is requiring a lot of additional information in order to perform these calculations. And I think number three is, even though the current proposal is not to take effect until after the 2022 tax year, the only way to implement and think about tax planning for international changes are going to require substantive changes, most likely to your supply chain. And therefore, tax planning cannot be done in a vacuum. And we are forecasting that modeling, implementation could take anywhere from 3 to 8 months to implement in order to have tax planning if these things do go through. Next slide, Ron. So I have a polling question. How will Build Back Better's international tax increases, how will it impact your strategic decisions? Are you thinking about changes to your supply chain? Would you be looking at outsourcing? Do you think it would be all of the above or none of the above? All right. Looks like we're close at 38% will impact none of the above. And it looks like a third, just about a third, are all of the above. And then about 1/5 will need to evaluate their changes to the global supply chain. Thank you. Next slide. So I think one of the biggest areas that is happening here, in the US, we do not operate completely on a territorial system. What happens when you pay taxes overseas, that income still gets recognized in the US, and the way you offset double taxation is through a foreign tax credit. You get a credit. Well, what the US is proposing here, or Congress is really proposing, is to go to a country by country approach for foreign tax credits. And what that means, and just from a very practical perspective, let's say you have operations overseas in one country, let's say the UK, they're very profitable. But let's assume that you want to go into a new market, but we all know startup losses, getting started in a new market, you're going to have losses. What will happen is that the income recognized in the UK will essentially not be able to be offset against the losses in country B, and you won't get to cross credit either. So what that really means for international businesses is that you will have stranded losses, and that if you have particular operations, you will potentially not be able to monetize or utilize your credits in that particular country in the US. So really, it's just fancy play of words on this country by country foreign tax credit, but really what it means is you're going to be paying more income tax in the US based upon your foreign profits because of these stranded losses. Next slide. The other big thing is the interest expense limitation rules that are coming into play here. There's the 163J, but there's also these new rules on 163N. And really what that means is that you would be reporting more on a global basis. If you are in a member of an international financial reporting group, what could happen is you could further limit your ability to take a deduction. So even though you have borrowings here in the US at the US level, that may not mean when you test on a financial reporting your whole basis, you may be overweighted in the US and not able to take an interest expense deduction in the US under 163N. We really think that this 163N is kind of one more thing in the weeds that could surprise a lot of people, and their limitations. And you can see there that it's a 3-year average excess interest expense. If it's greater than 12 million, it kicks in. And you also look at the 163J, or 110% of this US member's allocable share. Next slide. There are several bills going. I think some of the big things to keep in mind is you've got the House Ways and Means, then you have the Senate Finance Committee versions that are coming out that had a few other changes this week. I think the big thing is the Build Back Better tracks very closely with the original Ways and Means. There are slight differences, but they're not large. I think they all, for the most part, are tracking along, and they're all negotiating points, as Ron had mentioned previously. The biggest thing is the GILTI deduction is not as great in the Build Back Better compared to the House Ways and Means, which means you get a larger GILTI deduction. The other big thing that really occurred was Biden really wanted this thing called SHIELD, which was non-deductible payments to foreign parties. But I think, as a lot of you have seen, that once the OECD and the group of 7 got together and decided that there would be a global minimum tax, and received assurances that most country legislatures would try to move forward with a minimum tax in their particular country, the Biden administration dropped SHIELD, and now they've aligned with Ways and Means on the base erosion. The minimum tax deal, that's really what it really is for, is because of the 15% global minimum tax. As we talked about earlier, the effective dates have shifted to 2023, which is a good thing, because I think implementation, if this does come in, the ability for the software companies, for tax software, the ability to get data out of your accounting systems to do this could be quite complicated, and people are going to need just time to be able to access and do the reporting. And then, of course, planning will take quite a long time. Next slide. BEAT is a big thing that we've had some continual changes here, but I think the really big thing is it's a minimum tax play is really at the end of the day. If your company is greater than $500 million and you have a base erosion of 3% or more, you have to do these calculations for deducting payments to foreign related parties, and you could have a minimum tax on that is really what it's meant to do. A little bit beyond the concept here today, but I think the BEAT applies to a lot of companies that don't realize it, especially private equity groups and other things that go up through the chain. You can fall and be reporting BEAT and not realize it. 163N, I think, and Jay, it's just quickly to realize that in 2022, 30% of ATI, we're going to be adding back depreciation and amortization. So companies that did not fall within 163J may be falling within 163J this year because of the changes. And I think, Ron, that's it for me today. And I'll turn this over to you and Kathy for the SALT.
Good morning, everyone. Anytime we have federal legislation, we always have to look at the SALT impact, right? So the last bullet is really where you start when looking at the SALT impact of any federal changes that might go through. And it really comes down to how does the state conform to the Internal Revenue Code? Many states have rolling conformity, meaning that if there's a change at the federal level, it's automatically going to flow into the state taxable income unless the state chooses to decouple. So we have rolling conformity states. We have static conformity, meaning that the state conforms to the Internal Revenue Code as of a specific date, and then they continuously update that date as they see fit. And then we have some states which are fewer by far, are selective conformity, where they conform to only specific provisions of the Internal Revenue Code. So one of the biggest one of the provisions that has the biggest impact on the state and local tax side that you've heard, I'm sure, through the news is the SALT cap for individual income tax deduction. That is a hot button topic. It's very political. The SALT cap that was enacted by TCJA, limiting you to only $10,000 of deductions of state taxes, was administered or enacted by the Trump administration and viewed as an attack on Democratic states. So now on the Democratic side, they're wanting that, the progressives are wanting that cap eliminated, but then that really goes against the view of not giving tax cuts to the rich, right? Because it's mostly people that are in the higher earning wage brackets that are going to benefit from that SALT cap deduction, or from removing that SALT cap deduction. Okay, so the other provisions, so SALT cap, we'll talk about that. We'll talk about some of the state tax workarounds that have happened, and that's where a lot of legislative activity has happened at the state level. The second bullet, corporate 15% minimum tax on book income. If that were to go through, I would bet probably 100%, if I was a betting person, that at least one state would also adopt a similar tax. That looks great. If a company's making all kinds of income but not paying any tax, I could see the states really wanting to have a minimum tax on book income as well. They would have to enact that separately. And then some of the other provisions, 163J, 163N, and all of the international provisions. There are some states that have rolling conformity to GILTI, and those would be impacted, and subpart F and all of that. So those would be potentially impacted by any federal changes. So the takeaway again is, how do the states in which you have a filing obligation conform to the Internal Revenue Code? Okay, pass-through entity elections. Next slide. So this was the response of the states to the $10,000 cap on state tax deduction at the individual level. The states had a flurry of activity to try to allow these taxes to be deductible on the individual side, and figured out, okay, how can we do this? And they were looking at charitable contribution type deductions for contributing to state funds. And that did not fly. The IRS basically said, shut that down, saying you're getting value back of a tax credit. That's not going to work. You can't get the deduction. But if tax is imposed at a pass-through entity level, on the pass-through entity itself, it's generally deductible. And we have states that have set up taxing structures that have always taken that approach. Tennessee, DC impose taxes at the pass-through entity level. So state that's not new. And in order to change that, in order for the IRS to say, no, you can't do that, it would be very problematic because that has been the taxing structure for various states. Also, the Internal Revenue or the IRS came out with Notice 2020-75, and they suggested that that was okay. If there is a pass-through entity tax imposed at the pass-through entity level, that's generally deductible by the pass-through entity. So the states, in response to that notice, there are a handful of states that have enacted pass-through entity tax elections, and these are elective, except for the state of Connecticut. But the states that have enacted some statute, the number of them has increased dramatically since that Internal Revenue Code notice has been released. So 21 states so far have passed elective, or 20 are elective. One is mandatory, where you can elect to tax at the pass-through entity level. And by the way, this just puts pass-through entities on parity with C corporations. Because if you have a C corporation, they have a state tax, state income tax, they can deduct it for federal tax purposes. But then if you took that same business and it's a flow-through entity structure, all of a sudden they can't deduct any of the state income taxes. And so that is a big difference between the two entity structures now that never existed before. Now, you did have alt-min on the individual side that might cap the amount you can deduct in any year because you had to pay a minimum tax at the individual level. But this has really started, really giving a lot of desperate treatment between entity form. So states have generally taken two approaches to their pass-through entity legislation. One allows the individual owners of the pass-through entity an income tax credit for their share of pass-through entity tax paid by the entity. So if you have a partnership, you make this election, the tax is paid at the partnership level, and then the owner, when they file, and say they're all in the same state. If the pass-through entity is in Maryland, the owner's in Maryland, then when the owner files their individual tax return, they still start with total taxable income, but then they will get a credit for tax paid to other states on that same income. So they're not increasing their tax, they're just paying at the pass-through entity level, get a credit on their individual return, and all of a sudden we made this state income tax at the partnership level deductible for federal tax purposes. So we're not looking at an effective tax rate savings. We really are looking at the federal tax rate, the deduction of state taxes at the federal rate, which makes this very powerful. The second method of the legislation, the direction they're going, is to reduce the owner's state taxable income. So either the owner is going to get a credit for tax paid to other states for tax paid at the pass-through entity level, or they can remove the state taxable income by the amount that was included in tax on the pass-through entity return. Next slide. Okay, considerations. Before everyone gets really excited and makes an election in all the states in which these pass-through entity elections are available, you have to be careful. You have to make sure you qualify. First of all, some states you have to have all individual owners. State of California, you can't have any partnership owners. So you have to determine whether you are eligible to make the election. But then also you have to be very careful that you don't make matters worse and actually increase your tax. And one of the biggest pitfalls in this area is the inability of the resident. Again, if I'm in Maryland, if I can't get a credit for the tax paid at the pass-through entity level, then I just doubled my tax. So I want to say that again. If I can't get a credit, if I can't be made whole, if the owners of pass-through entities cannot be made whole, their tax just doubled. So you have to be very careful of where the owners reside. Can they get a credit or a deduction for the tax or income at the pass-through entity level? And we may have in this situation, then you can imagine, you can have owners that reside in different states. And some of the owners in one state can get a credit. And this is fantastic. The company's really profitable. I could get this great federal tax deduction. But then you have other partners that their tax doubles. So you could have winners and losers. So then we have to be careful of conflicts of interest within the partnership and who in the partnership has the authority to make these elections. And if that is not clear, partnership agreements may need to be amended. So we want to be careful to foresee these issues and problems on the front end before something bad happens, right? And then there are different rules on how the election is made. Can it be revoked? Is it just one time? Does it have to be made by a certain date? And I will say that the election is usually going to make sense, and you could go ahead and just check the box in this case. It's going to make sense if the owners are generally domiciled in the same state that offers the election, because within this pass-through entity election and legislation, if they're allowing that election to tax at the pass-through entity level, they're giving the owners the credit. Otherwise, they wouldn't have implemented the legislation. So if we have owners, if all the owners are in non-taxing states as well, so if they're in the state that has the pass-through entity election, or if they're in non-taxing states, generally, it's going to be favorable to make that election. Next slide. Here are the states. So you can see a lot of the states with 2021. This is brand new, and a number of the states are effective in 2022. But here are all the states, 21 states now that have some form of pass-through entity election. Please know that anytime you're dealing with the states, there's no uniformity, none at all. We were hoping we'd have some uniform legislation. So once you learn the legislation in one state, you can generally apply it to all states. Unfortunately, it's all different. So please don't get angry at your tax preparer when they say it's going to take time to sort this out and find out whether this works for you or would be beneficial and how to make the election, whether you qualify. Please don't blame them. It's the states that have enacted all these different, there's 21 different legislative changes that have to be analyzed in so many different ways. Okay, next slide. Okay, let's talk Nexus. I know that there isn't necessarily legislative changes in this area, and this is a legislative tax update, but there are some significant changes in this area that you really, really need to be aware of. Next slide. First of all, telecommuting. COVID, we have changed our world and how we operate. Consider telecommuting. What impact does that have on Nexus determinations? When you have employees that are working in other states, unless there's protection under Public Law 86-272, which we'll touch base on, unless there's protection, you're generally going to have Nexus, which means you're generally going to have filing requirements. And by the way, if you're depending on federal law protection, you may have just lost it if you have telecommuters in those states. Not only Nexus, but the impact on apportionment. You have payroll now potentially in those states. The impact on payroll taxes. Do I need to be withholding in all of these other states? When do I change the unemployment tax state? All of these issues need to be addressed for telecommuting employees. There are some, or I should say there were some COVID exceptions. Unfortunately, it was the minority number of states that said we have exceptions. If you're under a state order, we're not going to consider you creating Nexus by having an employee here. We understand with all the government orders, we're not going to harm you for that. As an FYI, all of those exceptions have passed. There are no more exceptions. So if the telecommuters are still where they were, you cannot depend on any exception. Next slide. Here is one thing really, really, really important for this industry for everyone to understand. We have had a massive change to the interpretation of Public Law 86-272, which basically states that you do not have to pay or be subject to an income tax if the only activity you have within a state is solicitation activity for the sale of tangible personal property. If you are depending on this, I'm sure you have looked at it. This slide shows what it applies to, what it does not apply to. Only income tax, does not apply to any other types of tax. Sales of tangible personal property, not services or intangibles. Interstate, so if there are foreign companies selling into the United States, there's no protection under this federal law. And if you're organized in the state, you're not going to get protection. Next slide. The MultiState Tax Commission, which is a quasi-governmental or group of governments, the state governments that come together to try to bring uniformity to their statutes. There are over 20 members of the multi-state 20 state members that generally will follow what the MTC puts out. There are associate members as well, and other states that are not members can also follow guidance that the MTC approves and issues. So as of August this year, please, this slide is so important. As a general rule, when a business interacts with a customer via the business's website or app, that business engages in a business activity within the customer's state. So anything you're doing over the internet, if you are providing technical assistance through a chat, if you are doing anything electronically other than soliciting for sales of tangible personal property, the MTC is taking the position that Public Law 86272 no longer protects you unless you have shopping cart type activities only. Next slide. So I'll bring you to the last bullet here. You can read these slides at your leisure. But this last one indicates that, if you simply have career opportunities, would you like to work for us? Here are a list of open positions. You can submit your application or resume or cover letter through the website, and we will look, and we're looking to expand our staff. If those are more than just sales rep positions that are soliciting sales for tangible property, if those are for other positions that are non-sales, guess what? The MTC says you now have Nexus in that state without any federal law protection. So again, anything occurring over the internet that's not solicitation of sales, the states are looking at trying to strip away that protection. Next slide. There's also one here that is probably applicable to this audience: warranties. You're doing any kind of warranty work. Selling warranty, technical assistance, any of those matters. Now, I was involved with the MultiState Tax Commission Working Committee and sat in on all those calls, and the practitioner community had given a lot of input. And one main item we kept saying is that, okay, we've done all these activities since 1959 when the federal law was enacted. We've done them over the telephone. That has never been a Nexus creating activity. So the MultiState Tax Commission is now kind of removing their view of anything done over the telephone as well, that if you're conducting any kind of service with your customer, they're not caring where it is. If you're conducting it with the customer, they're trying to say that's activity in the state and strip away the protection. So we're going to see a lot of litigation here. We're going to see a lot of challenges. Federal law, this is just their interpretation. Remember, federal law trumps state statute and state interpretation, but we will see a lot more challenges in this area because the states continue to be aggressive. Next slide. And you can look at this. There is one thing of note. There's the MTC encourages states to adopt a factor presence nexus standard. So if you're not receiving much revenue in the state, that you shouldn't have to file. Most of the states do not have that as of this point. Next slide. Okay, down to our last polling question. Our company is taking a federal Public Law 86272 position in at least one state. Are you depending on this federal law that we're only soliciting sales? We don't have to file tax returns in the state. And I'm seeing a lot of you. Yes, and that's been our experience with our client base. We have many, many clients depending on this federal law. We need to look at Nexus, not only from an economic Nexus standpoint, but the stripping away of federal law protection needs to be reviewed. So please, please, please know you have to look at Nexus. We've had significant changes in that area with both COVID, with the MTC and their activity. As well, if you're a pass-through entity, you have to look at pass-through entity elections for sure. Huge dollars at stake if you're very profitable, and then be mindful of the federal legislative activities at the state and local tax level. So we had 53, 52, we have over half, just over half of you are depending on this protection. So please talk to your partners and compliance team to take a look at that. They can get us involved, the state and local tax team, to assist you with that. Okay, I think that is everything. Next slide, I believe, is just questions, and I guess I will open it up. Well, here's our disclaimer, right? Don't depend on anything we say. Please talk to us. And then the next slide is going to be questions. And Matt, if you saw any good questions or comments you want to make, that would be great.
Yeah, so thank you, Kathy, and obviously Brian and Ron. Didn't see any questions come through. So just for those who are going to be with us for the next hour, after we'll take a short break here in a couple minutes. But for those of you who have questions or think about questions in that break, feel free to throw those in the chat. I think it probably goes without saying, going back to the beginning, many of you may be sitting there thinking about structuring. Both from just what's going on with corporate tax compared to what's going on with pass-through individual taxes. Kathy touched on some of the partnership, the PTE elections, and then for all of our manufacturers thinking about how they may have felt safer with 86-272 and may now be wondering whether they're still afforded that. So, and then from Brian's perspective, how you're currently structured and how you might be best structured in the future. I'm sure there's a lot of things floating around in everyone's minds on those. So happy to address those after this, and I mean that both after this session, but also down the road. So thank you again, Ron, Brian, and Kathy for all the insights. Really appreciate that.